Welcome back to the channel, or welcome to the channel. If it happens to be your very first time here, my name is Troy, and what you're going to see today is a small list of 5 high-quality dividend stocks that I think you must know about and research going in the next week. Now, the reason I said next week is because all the stocks you guys are going to see in today's video all have ex-dividend dates of the next week, which means you're going to get paid from all these companies sooner rather than later. If you guys want to make sure that you guys don't miss the opportunity to own these stocks before that ex-dividend date, it's probably going to be best to make sure you guys are subscribed with the bell rung so you guys get notified that these videos come out every single Friday at 8 a.m. Central Standard Time right here on the channel. But without further delay, let's go ahead and dive right into this week's list with number 5, Apple, stock ticker AAPL. Believe it or not, this is actually the very first time I'm speaking about Apple on this series right here on the channel, so let's go ahead and dive into the numbers behind this stock. Apple is a quarterly payer in the technology sector, paying $1 per share per year with a forward dividend yield of 0.42%. Apple has been paying and growing their dividend over the last 12 years, and right here's the reason it's not higher on my list, because their 3-year dividend growth rate is just 4.61%, and their 5-year dividend growth rate is 5.44%, but it is super sustainable because their payout ratio is just 12.17%. Now, at the time of recording, Apple was trading 9.27% off of their 52-week high. They have an ex-dividend date of February 10th with a payout date of February 13th, and looking here at this chart, you're going to be able to see the growth of a single lump sum $10,000 investment into this stock versus the S&P 500 10 years ago, while only reinvesting dividends since then. Apple would have turned that $10,000 into $89,311.49, which outperforms the S&P 500 by $53,789.93. Next up, and coming in at number 4, is Tetra Tech, stock ticker TTEK. Including today's video, this is now the second time I've spoken about this stock right here in the channel, and if you go back to the first time I spoke about it, which was just back on November 22nd of last year, TTEK is not only underperforming, but it's actually lost money since the first time I spoke about it, but you're going to be able to see the big reason why here in 1 second. TTEK is a quarterly payer in the industrial sector, paying 23 cents per share per year with a forward dividend yield of 0.63%. TTEK has been paying and growing their dividend over the last 11 years. They have a 3-year dividend growth rate of 13.64%, a 5-year dividend growth rate of 14.67%, and a payout ratio at just 14.59%. And this is the number I was alluding to earlier. At the time of recording, Tetra Tech was trading 28.13% off of their 52-week high, which is why we've lost money since I last mentioned. They have an ex-dividend date of February 12th with a payout date of February 26th, and the same chart here. Over the past 10 years, that lump sum $10,000 investment, only reinvesting the money they gave you in return, TTEK would have grown that $10K into $83,665.25, which outperforms the S&P 500 by $48,143.69, and that's including that 28% drop I just mentioned. Next up, and coming in at number 3, is Cintas, stock ticker CTAS. Including today's video, this is now the 4th time I've spoken about this stock right here on the channel, and if you go back to the very first time I spoke about this one on November 10th of 2023, Cintas is outperforming despite a pretty big drop recently, so let's go ahead and take a peek at these numbers. Cintas is a quarterly payer in the industrial sector, paying $1.56 per share per year with a forward dividend yield of 0.78%. Cintas has been paying and growing their dividend over the last 41 years. They have a 3-year dividend growth rate of 19.63%, a 5-year dividend growth rate of 17.95%, and a payout ratio at 29.67%. Now, at the time of recording, Cintas was trading 12.08% off of their 52-week high. They have an ex-dividend date of February 14th and a payout date of March 14th. And same chart, that $10,000 investment into Cintas would have been grown into $111,219.73, which outperformed the S&P 500 by $75,698.17. Woo! That was a crazy stock, and it was only number 3. With that being said, we're a little bit over halfway through this week's video, so please go ahead and leave a like on the video if you guys haven't already. It's free to you, and it helps me get my content out to others that also might enjoy it. And the best way to do that is by using the comment section down below. Let me know what you guys think of this week's list. Let me know if you guys own any of the stocks on this week's list, or you can just use the comments to say hi down below. But now, let's get to number 2. Coming in at number 2 on this week's list is MSCI, stock ticker MSCI. including today's video. This is now the 10th time I've spoken about this stock right here on the channel. And if you go back to the first time I spoke about it, all the way back on August 5th of 2022, believe it or not, MSCI is actually underperforming since I first mentioned it, and you're going to see why that's so shocking right here in a few seconds. MSCI is a quarterly payer in the financial sector, paying $7.20 per share per year with a forward dividend yield of 1.21%. MSCI has been paying and growing their dividend over the last 11 years. They have a 3-year dividend growth rate of 20.7%, a 5-year dividend growth rate of 20.5%, and a payout ratio of 37.64%. Now, at the time of recording, MSCI was trading 7.11% off of their 52-week high. They have an ex-dividend date of February 14th with a payout date of February 28th. And looking at this chart, you're going to see what I was talking about. A $10,000 investment into this stock over the past 10 years while only reinvesting dividends would have been grown into $122,359.86, which outperforms the S&P 500 by $86,838.30. So now you can see why I said it's so impressive that this stock's actually underperformed over the short term because of this long-term chart. And here's the moment you've all been waiting for. Number 1 on this week's list is Eli Lilly, stock ticker LLY. Including today's video, this is now the 5th time I've spoken about this stock right here in the channel. And if you go back to the first time I spoke about it, which was also on August 5th of 2022, Eli Lilly is crushing the market over the short term, and that will not be surprising at all once you see these numbers. Eli Lilly is a quarterly payer in the healthcare sector, paying $6 per share per year with a forward dividend yield of 0.74%. Eli Lilly has been paying and growing their dividend over the last 11 years. They have a 3-year dividend growth rate of 15.22%, a 5-year dividend growth rate of 15.05%, and a payout ratio of 20.49%. Now, despite this stock crushing the market over the short term like I just showed you, at the time of recording, Eli Lilly was actually trading 16.6% off of their 52-week high. They have an ex-dividend date of February 14th with a payout date of March 10th. And take a look at this chart. Over the past 10 years, a $10,000 investment into Eli Lilly would have been grown into $136,899.79, which outperforms the S&P 500 by a kind of noticeable $101,378.23. As I said earlier in the video, every single stock in today's video has an ex-dividend date somewhere between February 10th and February 14th. So if you guys happen to miss the video on Friday when I posted it, and it's after those ex-dividend dates, all these stocks are quarterly payers, which means you now need to wait at least 3 long months before you get paid from any of these companies, and we all know.
Ain't nobody got time for that.
Now, with that being said, you definitely already missed the ex-dividend date for all the stocks I mentioned in last week's video, but if you're in the market for 5 more high-quality dividend stocks that you want to do your own research on, you can check that out right here. But until next time, see you.